Okay, let's be real. Does the word materiality in an audit exam make your stomach just drop? You are definitely not alone. But what if I told you there's a secret weapon, a cheat code even, to turn that panic into points? Well, that's exactly what we're going to unpack today. Let's get right into it. You know the feeling. You flip open that exam paper and your eyes land on this monster of a question. Your heart sinks a little, right? It feels impossibly dense, layered, and specifically designed to trip you up. But here's the secret. It's not a trick. It's a test of a very specific skill. Can you follow a system? And that system is exactly what we're giving you today. So take a deep breath, because for that monster of a question, there is a framework. A clear, logical system that basically acts as a cheat code for any materiality question the exam can possibly throw at you. All right, so before we can use this cheat code, we've got to speak the language. Let's quickly decode the lingo, because once you've got these core ideas down, you're already halfway from exam panic to total pro. First up, overall materiality. The way I like to think about it is it's the big number. It's like the line in the sand for the entire set of financial statements. If an error or a bunch of errors added together cross this line, it's big enough to actually change the decisions of someone, say an investor or a bank who's relying on those statements. It's the big picture threshold. So where does this big number even come from? Well, you start with a benchmark. For a solid, profitable company, profit before tax, or PBT, is usually your go-to. Why? Because that's what investors and owners really care about, right? Then you apply a percentage, maybe 5%. But, and this is so important for your exam, you can't just pluck these numbers out of thin air. You have to justify why. Why PBT and not revenue? Why 5%? That justification is where you get the marks. Next up is performance materiality. This is your safety net, your buffer zone. We intentionally set this lower than overall materiality. The reason is pretty simple, actually. We're trying to avoid something called aggregation risk. That's just a fancy way of saying we don't want a ton of tiny little errors that on their own are no big deal to suddenly add up and blow past our main materiality limit without us noticing. And finally, we have specific materiality. This is for the really sensitive stuff. You know, certain things in a financial report where even a small dollar mistake could be a huge deal. Why? Because of their nature. We're talking about things like transactions with the CEO's family member or how much the directors are getting paid. For these areas, the dollar amount isn't the only thing that matters. So we set an even lower, super strict materiality level just for them. Okay, you've got the lingo down, you know the key players. Now it's time to reveal the cheat code itself. This is the step-by-step framework that's going to be your best friend in the exam. And here it is, your 6-step game plan. First, you choose and justify your benchmark, like PBT or revenue. Second, you apply a percentage based on the company's risk profile. Third, you set your performance materiality, that's safety net. Fourth, you decide if you need specific materiality for any sensitive accounts. Fifth, you set a trivial threshold for stuff that's just too small to worry about. And the grand finale, step 6, you use all of this to plan your audit and, most importantly, to evaluate any misstatements you find. Now, this framework isn't just a list. It's a tool, and you use it based on the task word in the question. If the exam says evaluate, the marker is looking for your professional judgment. You have to justify every choice you make. If it says explain, they want you to break it down. Make it super clear why you're doing what you're doing. It's all about showing them your thinking. Okay, theory time is over. Let's make this real. We're going to apply this framework to a real-world, well, kind of real-world scenario. Let's head over to a certain burger joint you might just recognize. Our task word here, evaluate. All right, here's the situation at Bob's Burgers. We've got the key financials. Revenue at $500,000, PBT at $50,000. And here's the issue. Bob splurged on a $4,000 Espressonator 3000. He bought it from a company owned by his landlord's brother, Mr. Fishorder's brother. To make matters worse, it's been booked as a repair, but it kind of smells like it should be an asset, right? Okay, let's fire up the framework. Step 1, choose the benchmark. For a small business owner like Bob, what's the number one thing he cares about? Profit. So profit before tax is our best bet. Step 2, apply a percentage. Nothing in the scenario screams high risk, so a standard 5% seems reasonable. 5% of $50,000 gives us an overall materiality of $2,500. And step 3, set our performance materiality, our safety net. Let's use 70% of that, which lands us at $1,750. Simple as that? Now for the big finish. Step 6, evaluating the misstatement. Let's look at the numbers first, the quantitative part. The $4,000 error is way bigger than our performance materiality of $1,750, so check.
It's quantitatively material. But, and this is the merit level part, look at the nature of it, the qualitative side. It's a transaction with a potential related party. That's a huge red flag. So even if the number was smaller, this would still be significant. Our conclusion? This misstatement is material on two fronts. It has to be corrected.
Perfect. See how that works? Now let's try a different scenario with a different task word. Let's check in on Linda's new catering side hustle. This time, our task is to explain and audit risk. So here's the deal with Linda. She's running this new catering gig, which is great. The problem, she's dipping into the restaurant's cash register to buy supplies, and she's not really keeping receipts. The total of these undocumented expenses is around $3,000. Our job is to explain why this is a red flag for us as auditors. When the question says explain, I want you to think what, why, and so what. So what is the issue? Well, the potential misstatement is $3,000. Using the numbers from Bob's case, that's well over our performance materiality of $1,750. So it's definitely material. Why is it a risk? Because the internal controls are terrible. Using cash with no receipts is just asking for trouble. It means there could be way more errors we don't even know about. And finally, so what? What does this mean for our audit? It means we can't just trust the numbers. We have to design very specific audit tests to go and verify these cash expenses. See, materiality wasn't just a number. It was the starting point for our whole explanation. Okay, you've seen the framework in action twice now. Just following those steps is going to get you a solid pass. But we're not aiming for a pass, are we? We're aiming for merit. To do that, you need to know the common traps people fall into and how to leap right over them.
Just look at the difference here. A pass answer says, the $4,000 misstatement is material because it is over the $1,750 performance materiality. It's fine, it's correct. But a merit answer, it goes deeper. It says, the $4,000 misstatement is quantitatively material as it exceeds PM. Crucially, it is also qualitatively material because it involves a potential related party, a factor that could independently influence a user's decisions. You see that? It hits both angles and links it back to the user. That's the money shot right there.
So let's nail this down. Here are the top 3 exam traps you are now going to avoid. Trap number 1, poor justification. Never just pick a benchmark. Always explain why. Trap 2, forgetting qualitative factors. Always have your spidey senses tingling for things like fraud risk or related parties. And trap 3, mechanical calculation. Don't just be a robot punching numbers. Tell the examiner what those numbers mean for the audit. All right, let's bring this all together. A super quick recap and the one key takeaway that's going to be your final marks booster.
Here it is again, the whole framework in 10 seconds. Ready? Benchmark, percentage, performance, specific, trivial, evaluate. Burn that into your brain. That's your roadmap.
And I want to leave you with this one last thought. A framework like this doesn't just help you find the right answer, it helps you prove it. And in an audit exam, proving your judgment, showing your work step by step, that is how you get every single mark available. Now go nail it.